Hey guys, John Polemy here, Actionable Intelligence. Today is Saturday, August 25th, 2018, and today we've got the weekly market update. So I wanted to talk a little bit about the uranium price and get some perspective here. It's kind of chuckling. I was looking at some exchanges on Twitter, some emails that I've gotten, and people are still commiserating or anxious about the uranium price. When's it going to start moving? So I threw this chart up here that I got from John Quakes off his Twitter feed, and you can see from mid-April to current time, the uranium spot price is up 28% in about 4.5 months. This is when we've had the most bullish news in a waterfall fashion that we've had in years, and the spot price has responded. So let's put away the angst, the hand-wringing. We're in a bull market. We've seen the bottoms. The supply destruction has taken place and will continue to take place until prices rise sufficiently. We are also going to see continued investment flows into the metals, into uranium. One thing I think people need to realize is if you're a big money operation where you control billions of dollars, you're not going to be in there buying junior mining stocks. People that are going to participate in the uranium market as they see the opportunity are going to want to put a large sum of money into something, and it'll more than likely be physical metal or a big company like Cameco that can absorb the investment flows. So I just wanted to throw this up there to maintain some perspective. The bull market is intact. Just got to sit back now. It's going to play out over several years. It's not going to happen in a week or two or a month. I think this is where a lot of amateurs and some of the uninitiated or people that are new to this want everything to happen in a month or two. That's not how it works. As I've said, it's going to play out over a few years. Just be patient. Speaking of spot purchases in the spot market, this was a tweet that I saw from Alex Molyneux. He is, of course, the CEO of Paladin Energy, which is the company that owns the Langer Heinrich mine in Namibia that's currently on care and maintenance. And he wrote a tweet that said, "Looks like Cameco just put out a tender for 500,000 pounds of uranium for Q4 delivery, non-Russian origin material. Bids due at the end of the month. Guess the buying is real and it's starting." So I think this is a guy that would know what was going on. He's a CEO of a uranium mining company. He's going to see the tenders or the RFPs, the requests for proposals. People were kind of wondering when the buying was going to start. Looks like Cameco's out there putting out feelers, trying to buy material. So this is just part and parcel, another piece of the puzzle that that overall mosaic of that uranium bull market that's starting to take shape in front of us on this puzzle board. The other thing that I wanted to bring to people's attention, this is kind of my favorite chart actually when it comes to uranium. It's the chart that shows the uncovered uranium demand by utilities going out for about 13 years, 12 to 13 years. And as you can see, as time goes on, the amount of material that's required by the utilities that's uncovered, which means they have not contracted for, grows year after year. And what I think is interesting, when people look at this, they might say, well, there's not really a lot of uncovered demand for the next few years. Yes, but you need to understand that with supply being diminished and been retarded by the mine closures and the mines that are put on care and maintenance, that's changing the perception and mindset of utility fuel buyers. Remember, most utilities buy their uranium not in the spot market, but in the term market and in long-term contracts of 5 to 10 years. So if you're a utility who's had a fuel deal with a miner, let's say Cameco, and it's rolling off this year, you're going to be looking out 5 to 10 years, and you're going to start wanting to go and secure material for your reactors for that same period of time. Now, when you go out and put an RFP out, which is a request for proposal to various uranium suppliers, and you say, yeah, I'd like to buy, 10 million pounds over the next 10 years at $28 a pound, you're not really going to get any feedback on that. And that's what I think we're going to start seeing. As this time goes on, the amount of uncovered demand builds, the RFPs go out, the information comes back to the utilities that the material's not available at these low prices, and that's when we're going to start seeing contracts being signed at higher prices. So this is one of my favorite charts. I like to look at it because it really tells the long-term story on the demand side for uranium, and the fact that most of these utilities do not buy in the spot market. They buy in long-term contracts, and the further you go out, the less material has been bid for. So this is very positive. Another thing I wanted to talk about today was Goring and Rosenzweig put out a blog post. It was related to grains. If you don't know, Goring and Rosenzweig are a commodities fund manager in New York, but what I like about them is they put out extensive and very accurate research around commodity markets. I mean, every quarter they come out with a 25 to 30 page report, covers all various commodities, and they occasionally put out some blogs. And I just put out a recent blog on grains, and I just wanted to talk about some of the highlights in the blog that I thought were very interesting. As you may recall, especially the frequent viewers of the channel, I recently had a video about corn and agriculture. I'm starting to get more and more interested in that part of the commodities market, just because of the fact that the soft commodities, agriculturals, have been beaten down for so many years. So I think the worm is beginning to turn there also, and we're definitely taking a look at it. But going back to the blog, the GNR blog, they put out some reasons to be bullish, and these are very interesting. Just go over them quickly. Saying that global grain demand is surging, especially global soybean demand, which is growing at 5% per year. Rule of 72 would say that you're going to double grain demand about every 12 to 13 years. Surging soybean demand from emerging markets requires 10 million new soybean acres to be planted per year. One of the things I pointed out in the last video I did about agriculture is the trend around the world for less arable acres per capita. What we are seeing is because of climate change, because of development, because of lack of investment, we are seeing, and of course on the numerator side, more population, we are seeing less acres being available to grow crops per person over the years. It's declining. So that requires more intensive agricultural practices, more inputs, i.e. fertilizers, and more technology be applied to the remaining acres to get the same yield or a higher yield. The other things that I think is to be noted when it regards to agricultural is the fact that over the last 4 or 5 years we've had bumper crops. We have not had any really big weather events to affect overall crop yields around the world, and I would suggest that that is a cyclical phenomenon also. People should note that it's my view that we are going to be going into a more volatile climatic events, not necessarily getting hotter, but actually getting colder and wetter. So I suspect that we will be seeing suboptimal growing conditions in various places of the world that could also retard production of crops. Just talking about the soybean demand, what happens then is that as soybean demand surges and the price for the crop is higher, people shift production from other grains, i.e. corn and wheat, into soybeans. So that begins to retard the amount of supply of corn, all the while global corn demand continues to set records. And the reason corn is setting records is because as the emerging markets become wealthier, people there, as they get higher incomes, begin to move from a predominantly plant-based or grain-based diet to adding more protein, i.e. meats like beef, chicken, and pork to their diet. These are extremely grain intensive. I think it's something like 8 pounds of corn to produce 1 pound of beef, something like 5 or 6 pounds of corn to produce a pound of pork, and something around 2 pounds of grain to produce a pound of chicken. So as people get wealthier around the world, they like to go out to eat. They eat steaks, they eat more pork, they eat more chicken. Obviously, the demand for those increases, then the demand for animal feed increases, i.e. corn demand. Corn demand is growing at 5% a year in China, and we are now seeing the fact that Chinese corn demand is exceeding supply, which is going to force China back into the world market to buy corn. The other thing that's interesting is that for some reason, unbeknownst to me, the Chinese are going to be instituting an ethanol policy, which is going to add an extreme amount of demand to their corn demand. So that's another factor to add to Chinese corn demand. But we'll see if that really happens. I think if the price of corn skyrockets, which is what I expect to happen over the next couple of years, I don't think that they'll be instituting their ethanol program. Nevertheless, becoming more and more bullish on agricultural stocks, agricultural markets. I do have some positions in some foreign farming companies. I have been looking around at the fertilizer stocks, but not necessarily ready yet to pull the trigger. So we had a viewer question come in I wanted to talk about. I thought it was interesting. This is from the gold video I did a couple months ago, reviewing the 2018 In Gold We Trust presentation that was put out. I'll just read the question. Excellent video. I am extremely bullish on gold and believe the current financial setup is unsustainable and will lead to an eventual collapse. Could you explain in more detail the effects of an inevitable stock market crash on the commodities market? You mentioned this in your video already, but I would be interested in a full-length analysis and prediction if possible. Keep up the great work. So I don't really think a full analysis is required. I think what is happening is very simple. We are in a liquidity-driven bull market in all things. Since the last great financial crisis in 2008, there has been a concerted effort, not just by the Federal Reserve in the U.S., but by all major central banks, to create trillions and trillions and trillions of currency units in order to buy back sovereign bonds, and in case of some countries like Switzerland and Japan, just to go out and buy other financial assets, i.e. stock ETFs, corporate bonds, things of this nature. When you can just create currency units out of thin air and go buy assets, this forces up the price of the assets. It's supply and demand, liquidity driven supply and demand. So we have seen asset prices in most asset classes skyrocket over the last 10 years. We are now seeing, at least in the US, the tightening of removal of the quantitative easing that was in effect, along with rising interest rates by the Federal Reserve. This will have the effect of beginning to siphon liquidity out of the markets, which was the, to use a Larry Kudlow term, mother's milk of these markets. So it would be logical to assume or to posit that if we had the view that a lot of the financial markets were driven by the creation of currency units out of thin air that were then used to buy assets in the financial markets, ergo those financial assets increased in value. If you withdraw liquidity, we would suspect that the reverse would happen. Now, there's no guarantee that that's going to happen, but I will say this: the research is not in doubt. When the Federal Reserve goes into a cycle of raising interest rates, that has led to recession like 11 out of the last 12 times they've done that. So they will continue. This Federal Reserve Chairman Powell has stated that they're going to continue to raise rates. There's been no indication they're going to stop. And my suggestion is, or what I am asserting is going to happen, they are going to raise rates till they break something, until there's a crisis in the corporate bond market, the sovereign bond market. We've already started to see some cracks begin recently in the last couple weeks around the world because of the strengthening dollar. The strengthening dollar has put pressure on emerging market currencies, i.e. Turkey, which is in crisis, and other countries like Argentina. So that could lead to a sovereign debt crisis that begins to spread into the banking system. There's no telling how this is going to play out. That's why you must stay on top of these things and see how the cracks in the ice develop. You know, we cannot make predictions. We know that when you raise rates like this and you have a financially bastardized system like we have, that when you start messing around with liquidity like this and making these changes, we're going to see, it's like the game of Jenga. You start pulling out the little blocks at the bottom. You don't know which block you pull out is going to be the one that brings the whole structure down. But that's similar to what's going on. That's why we just have to watch this thing on a week-to-week, month-to-month basis and play it as it comes. Now, long-term, talking about gold and commodities that are all-time low versus financial assets. Now, that doesn't necessarily mean that when financial assets come down in value, that commodities are going to go up. What it means is, relatively speaking, I suspect over the next whatever time period, 5-10 years, we're going to see resources and commodities outperform financial assets. That's my prediction. So I own gold. I own gold as an insurance policy. I own selective gold mining stocks, predominantly royalty companies, to take advantage of a higher precious metal price. The reason I like royalty companies is because I'm not subjected to the same amount of risk that a mining company is, with all the risks they have around finding, developing, permitting, and operating a mine. Royalty company just gets a cut right off the top of the revenue, and that's fine for me. I can participate, and it has been shown, if you look back in history, that the royalty companies perform quite nicely even when the gold price is stagnant or in decline. In addition, I retain optionality with royalty companies because it's typical for a royalty company, when they sign a royalty with a gold mining company, to tie up additional acres around the existing mine and be able to participate in any further finds or discoveries of gold. So what I think is going to happen, just very quickly in a synopsis, is we're going to continue to see the United States Federal Reserve tighten. They're going to tighten until something breaks. It could be a continued surge in the dollar, which causes emerging markets to crack and not be able to pay their debts, leading to a banking crisis and a sovereign debt crisis. Certainly, we're going to eventually, if you continue to raise rates, force the economy into a recession. I do not know when that's going to happen, but that will eventually happen. In a scenario like that, you know, the United States is the engine that pulls the global train. And if you have a recession in the United States, I would suggest that you will see that percolate into various emerging and frontier markets around the world. That would be negative for commodities in the short term. They would go down, the demand would go down, but we need to understand that many commodities are in supply deficits, i.e. uranium. Uranium is continuing to perform even though other commodities are in decline. So you have to analyze things on an individual basis and not just make general statements. In general, if you remove liquidity, asset prices go down. I would suggest that gold would go down, commodities would go down, but you need to remember something. Once the economy rolls over and we get into some type of financial stresses in the corporate bond market or sovereign bond market, I can promise you one thing. The central banks will reverse their policies and flood the system with more currency units. This is what they do. They're walking around with a 10-pound sledgehammer, and they think they can solve every problem by swinging that sledgehammer and hitting the problem with that sledgehammer. So when they remove liquidity in the cycle we're in now of raising rates, eventually something's going to break, i.e. the economy, the sovereign bond markets around the world, corporate bond markets. Once they break it, they'll be right back again. The cycle continues. They'll lower rates. They'll enter into QE4, 5, 6, whatever is required. They'll buy whatever amount of assets. We've seen other central banks around the world that are further advanced on this line, like Japan. The Japanese central bank owns like over 50% of the Japanese government bond market. We'll see whatever is required, because the one thing that cannot be allowed to happen is a deflationary depression. That just wipes out everybody. A certain amount of inflation, a certain amount of, can be handled and is actually desired by the financial masters of the universe. The thing that cannot be counted on or cannot be allowed to happen is a deflationary depression collapse. So I would suggest that after a year or 18 months of declining commodity markets, after the initiation of a recession, you would see a flooding of the markets of liquidity again, whatever amounts are necessary. That would take 12 to 18 months to begin working its way through the system, and you would see another inflation take place and rising commodity markets and gold. So I don't know if I answered the question, but that would be the answer to my question. Now, you just have to keep an eye on it. Like I said, we don't know how it's going to play out. It's hard to make predictions about the future. Obviously, that's a Yogi Berra type answer, I know, but that's just the facts. We know how this works. Like I said, we just have to see, kind of like analyzing earthquakes. We just have to see how the tremors play out and what effects it has on the surrounding markets. So that's the answer to the question. I definitely appreciate it. Keep sending the questions in, guys. I'll try to answer them to the best of my ability. The other thing I wanted to talk about is I just started a Patreon channel. If you so desire and you find value in these videos that I'm making, and you have some desire to reward me or compensate me or throw a couple bones my way, I'll put up a link for that. One of the things I can do to motivate you to drop a few coin on John is to, if you go to my Patreon and you donate at least $5 or sign up for a reoccurring donation, I will send you a this month's issue, or this month's stock pick from the Actionable Intelligence Alert, so you can get a flavor of what we are investing in or what we're speculating in, and what type of stocks that we're involved in. So I'm happy to do that for anybody that wants to donate a certain amount or a reoccurring collection there. Also, I'd like to remind people about the Actionable Intelligence Alert. I think so far it's doing fairly well. We continue to get subscribers. I encourage you to take a subscription. It's only $79 a year. A lot of things that we talk about on these videos, we are playing out in real time in the Actionable Intelligence Alert. A lot of our uranium picks are up well over 50% already, and we are doing fairly well there, I believe. So if you're interested in that, there'll be links for both of these in the show notes. I want to continue to thank the subscribers and people that watch my videos. I appreciate it. The channel continues to grow, and as long as you guys keep supporting me, I'm going to keep doing this work. So thanks a lot, and we'll talk to you next week.